Hey everybody, Ryan here with Duckett Ladd Dental CPAs. I've got Matt joining me on the call today, and today we're going to talk through the tax strategies that every dentist should use in 2026. We will kick it off with talking about entity structuring and how the S Corp can be advantageous. So Matt, you want to tell us kind of what the S Corp is and how it can be a good tax strategy?
Yeah, thanks for having me, Ryan. So this is a good one. We have a lot of clients who come on board and ask us questions like, when can I be an S corp? Should I be paying myself a wage? The answer is it just kind of depends. A lot of dentists leave money on the table just because they're structured wrong. The S corp can be huge because it lets you split income between W-2 wages and distributions. Still going to have to pay yourself a reasonable salary, but those distributions don't get hit with payroll taxes, which could save you tens of thousands per year.
Yeah, so the S Corp is a no-brainer for most dentists and most taxpayers. Couple small exceptions, maybe if you're in a state like Tennessee, there's some different state taxes that it may be best to stay as a Schedule C. But typically, getting that S Corp structure in place is the best bet to save yourself on some self-employment or payroll taxes. All right, strategy number two, retirement plans. Make sure we're maxing those out.
Yeah, this is a simple one, but powerful. Maxing out retirement isn't just about saving for later. It's about controlling your tax liability now. So things like a solo 401k or profit sharing plan, they let you move money from a high tax bracket into a tax deferred environment, still let you keep the flexibility. So where dentists get tripped up is either they're not contributing enough or they're contributing without coordinating it with their overall tax strategy. Timing really matters on this one.
Yeah, so the theory is right now, very high earner, probably the top tax bracket. If you can defer some money into a tax in the future where you'll be in a lower tax bracket, you'll save money in the long term on taxes. Talk with your CPA about which plan could be best for you, or a retirement plan administrator on which plan could be best for you and your specific office environment. All right, next strategy would be leveraging bonus depreciation.
Yeah, so this one was kind of up in the air prior to that one big beautiful bill passing back in July, but it's back. It'll be here until at least 2029. It lets you write off large equipment purchases much faster. But the mistake that I see people making here is kind of pulling the trigger on that too early. This is one that you want to time in a high income year. If you're a startup or maybe you're having a down year, it might not be the year to purchase that equipment. We always like to say, don't let the tax tail wag the dog. Make a decision that's right for your practice. But if you are having a high income year and you do need some equipment, that could be a pretty large immediate write off that you take advantage of.
Yeah, and you can take that deduction if you finance the equipment or pay for it in cash. So if you don't have the cash to buy it outright, you can still take the full deduction even if you finance it. All right, the fourth strategy here is the health savings account.
Yeah, so in my opinion, this is the most underutilized one. We have a lot of dentists that come in with really low deductible, really high premium health insurance, and maybe they don't need that coverage. And it's really a lifestyle choice before it is a tax choice. But maybe you're in open enrollment right now, maybe not. This one's definitely worth exploring. But like I mentioned, if your out-of-pocket medical is traditionally low and you have an expensive low deductible plan, you're probably leaving some money on the table. I like the HSA because it has a triple benefit, which it's really hard to come by in the tax world. First, the money you put in there is pre-tax. So every dollar you put in is a dollar you're not paying tax on. At the max family contribution for 2026, I think it's 8750. Could be a pretty significant deduction there. And then secondly, the HSA is an investment vehicle, and the balance can grow tax-free depending on how you use it. Depending on how that investment does, you could be looking at hundreds or even thousands of dollars in tax-free growth. And then third, as long as the money in the HSA is used for qualified expenses, withdrawals from that account are tax-free.
Yeah, and then one more perk or benefit of it is it can kind of double as a retirement vehicle. So once you hit a certain age, you can pull the money out without getting a penalty, and you're just subject to normal income tax rates at that point, and very similar to a 401k. And again, you've got to be in the right health insurance plan, like Matt mentioned. You've got to be in a high deductible. So if your family's relatively healthy, you can get into that high deductible plan and start contributing to an HSA. Next strategy here is the pass-through entity tax.
Yeah, this is a big one for dentists in a state that has income tax. States like Texas, Florida, this isn't going to be a strategy you can take advantage of. And I will note that not every state that has income tax has PTE legislation enacted. Pennsylvania comes to mind as one that doesn't, but the majority of them do. And we see pass through entity tax save clients thousands of dollars all the time. So for years now, individuals have been restricted to a $10,000 deduction of state and local taxes on their personal return. You may have heard that this recent tax bill raised that cap to 40,000, but that's only for people under a certain AGI or adjusted gross income. In reality, a lot of dentists phase back down to that $10,000 cap. So PTE is a no-brainer if you can take advantage of it. So PTE stands for pass-through entity. So think S corp or partnership. States will allow a pass-through entity to pay tax on the net income from the business. Gets a little tricky from there. Some states allow you to exclude the income subject to PTE from taxable income. Some allow the PTE as a credit on your personal return. So this is where you definitely need a CPA involved. But either way, it's a workaround on that $10,000 cap. And again, we see it save our clients a significant amount of money.
Exactly. So, like you said, if you're a high income earner, you're paying more than $10,000 in state and local taxes. That includes property tax on your personal residence. Makes sense to do the pass-through entity tax if you can, if your state allows it. Talk to your CPA to see if it's something that you can use. All right, next strategy here is employing your family members.
Yeah, I think this one gets misunderstood all the time. I've had a lot of clients come over from other firms who haven't really thought to do it. When it's done correctly, it can shift income to lower brackets and help fund things like college or Roth IRAs. But it's important to be able to demonstrate that the family members you're paying are actually eligible for compensation. For a lot of our clients, that comes in the form of marketing. So they're using images, names, likenesses of their family for advertising. So pictures on the website, hanging around the office, that makes your family members eligible for compensation. So depending on your kids' ages, there are certain amounts that we encourage that you pay them. It's important that for minor children, if they don't have any other earned income, we want to keep that pay under the standard deduction if possible so that they're not incurring income tax. They'll still need to pay payroll tax on those wages, and the IRS will want to see a W 2 issued to them if the money will be invested.
Yeah, and then one other way you could use this strategy is employing your spouse. So if you want them, now the only reason to do that would be to have them contribute to a retirement account. Otherwise, their income is going to stay in the same tax bracket as yours. But if you want to employ your spouse to have them maximize their retirement plan contributions, that would be another strategy you could use by employing your family members. All right, and then the last strategy we're going to talk about today, Matt, is the Augusta Rule.
Awesome. Yeah, we love a good loophole. This one's low hanging fruit. It's blatantly out there in the IRS code, but essentially, you're able as an S corp shareholder or partner in a partnership to rent your home to yourself or to your business up to 14 days or 14 times per year, tax free. This one's named after the Augusta National Golf Course where the Masters takes place. A lot of people around there take advantage of the Augusta Rule around that time. So you basically get to pocket the money. You don't pay income tax on it, and your business gets to deduct it as long as it's under that 14-day threshold. A few things to document. First, we encourage that you call a conference center or a hotel near you to see how much it costs to rent their space for a day. You're going to need some sort of comparable rate to charge yourself. We don't just want that to be an arbitrary number. And then second, you should be keeping a record of every instance of home rental. Fingers crossed we won't have any clients ever be audited, but if they are, we want them to be able to defend themselves.
Yep, exactly. So again, this is for homeowners. You have to be owning your house, but if you do own your home, then take advantage of this. Use your house for business meetings, get that tax write-off, and you don't have to pick up the income as personal income. So, all right, those are the tax strategies that every dentist should be using in 2026. Thanks, Matt, for jumping on.
Thanks for having me, Ryan.